Global markets pushed higher over the September quarter, supported by resilient corporate earnings, easing inflation, and growing confidence in a soft landing. The US Federal Reserve's first rate cut of the year signalled a shift towards easier financial conditions, while enthusiasm around artificial intelligence drove further gains. Although tariff concerns and softer labour data lingered, sentiment remained positive. Australian shares extended their rally before easing back in September. Early strength reflected resilient domestic demand and supportive policy settings, but sentiment softened on weaker growth data and slightly higher inflation. International shares delivered strong results, led by the US, where lower inflation, solid earnings, and central bank support pushed markets to new highs. Emerging markets also outperformed on improving confidence in China and continued optimism towards technology-led growth. Fixed interest markets delivered modest gains over the quarter. US Treasury yields declined on expectations of further monetary loosening, supporting global bond returns. Australian bonds delivered smaller gains as local yields moved higher, reflecting reduced expectations of rate cuts. Credit markets performed well, with stronger investor demand supporting both investment grade and high yield sectors. As 2025 draws to a close, the global outlook remains balanced but constructive. Economic growth is steady, inflation broadly contained, and policy settings supportive. Structural themes such as AI investment and the revival of emerging markets continue to underpin opportunity. However, valuations remain elevated, and we need to be mindful of the headwind this creates for returns over the longer term. While policy uncertainty has abated, we're not completely out of the woods, as demonstrated by the latest flare-up in US-China trade tensions and the related market sell-off. On balance, we remain comfortable with our exposure to risk assets, particularly those benefiting from a global rate-cutting cycle, such as smaller companies, real estate, infrastructure, and certain emerging markets. These asset classes also tend to be trading at more reasonable valuations. As ever, maintaining diversification and a disciplined approach remains essential. But for now, resilience, not fragility, continues to define global markets.